happened.
Uh,
High Waterstone. This is one of those weeks where the bond market, geopolitics, and mortgage rates are all colliding. We've got mortgage rates sitting at multi-year lows, hot producer inflation data, and a major escalation in the Middle East, pushing oil and gas prices sharply higher. The good news, you've likely seen the recent headlines noting the 30-year fixed mortgage rate fell below 6%, with Freddie Mac quoting the PMMS rate at 5.98%. These headlines create opportunities. Borrowers see them and have renewed interest in both purchases and refinances. While that's a positive headline for the housing market, it's important we calibrate expectations about what that number actually represents. It's a national average of a strong credit profile borrower scenario and includes many different lender types. It's also not a zero cost rate. It does have the assumption of discount points. So this market is representing one of those little refi boomlets we've mentioned. We might see this year. This sub 6% headline creates momentum and optimism. The value comes from turning that headline news into clear scenario-based pricing conversations. On Friday, core PPI, which strips out food and energy, jumped to 0.8% in January, its biggest monthly increase since July of 2025. Key services that feed into core PCE were mixed. This points to a stronger core PCE reading for January, which would support the Fed staying on hold for the next couple of meetings and keeping June as the first realistic opportunity for a rate cut. Bond pricing is slightly weaker in early trading as Treasury yields inch higher, with the U.S. 10-year moving from an opening near 3.9% to above 4.02% after briefly dipping below 4% last week. Yields are pressing higher this morning, even though we typically expect a stronger flight to quality bid during geopolitical flare-ups. Over the weekend, the U.S. and Israel launched strikes in Iran that killed their supreme leader, and Iran has responded with retaliatory attacks on U.S. bases in the region. Oil prices have moved up on the conflict, stoking concerns about renewed inflation pressure. In addition to geopolitical news this week, we have an abundance of economic data releases, which I'll pass it on to Casey to provide.
yeah, thanks, Tracy. So we start March with a data lineup that's headline light but still market relevant, that's centered around manufacturing and services activity, regional economic snapshots, and of course, Friday's labor market report. Monday kicks off with a focus on manufacturing conditions. Both the S&P Global and ISM Manufacturing PMI reports for February are scheduled and will offer insight into factory sector momentum. There are no data releases on Tuesday, but there are three Fed speakers scheduled. Wednesday brings the ISM Services PMI for February, which is a key reading given that services activity compromises roughly 70% of the U.S. Economy. Wednesday morning, we also do get the MBA mortgage applications number. Thursday sees initial jobless claims and the import price index. And the centerpiece comes Friday when the U.S. employment report is released. Markets are currently expecting modest job growth with only 60,000 plus jobs forecast and the unemployment rate steady near mid 4% levels. The details on wage growth and sector gains, not just the headline payroll count, will be key for traders and economic strategists sizing up whether the labor market is truly cooling. That's all we have for this week. We hope you have a great one.